So advanced financing decisions. Ladies and gentlemen, very soon when you'll find yourself being a finance manager of some of these biggest organizations, apart from making these investment decisions, yes, you have told us as Safaricom that we need to go to the Ethiopian market. The biggest question will be, how do we raise finances for this kind of a project? That is now all about these financing decisions. So nature and objectives of this financing decision, we are writing there. The first item that this examiner wants us to look at is the nature, and objectives of the financing decisions. So tell us then, we start like, these are decisions on how to finance operations. These are decisions on how to finance operations through an optimal mix. On how to finance operations through an optimal mix of debt, talk of equity and preference share capital, and the preference share capital. Here you see retained earnings is part of what here? Equity. Objectives. The main objective, of course, is to minimize WACC. You'll be asked this in your exams. The main objective of studying this topic is to enable us understand how we can help organizations minimize WACC. So what does WACC stand for? Weighted average cost of capital, yes. Into brackets, weighted average cost of capital. Then number two, just a moment, I mute everybody here. So number two is to help in maximizing firm value. Maximizing firm value and the shareholder wealth and financial, or rather, and shareholder wealth. Yeah. Number three, maintain financial flexibility and control. Maintain financial flexibility and control. When we are financially flexible, it means that at any given time we can switch. Is it debt we want? We can raise debt. If we want equity, we can talk to our ordinary shareholders. They buy more shares. So maintain that flexibility and control. And then number four, balance risk and return. Balance risk and return through optimal leverage. Through optimal leverage. Now, ladies and gentlemen, as we continue, of course, I'll be able to prove to you that always debt is good, even at our personal levels. If you realize that you are operating without debt, then straight away you have a problem. So does it mean that Mwalimu is encouraging that you go borrowing? You borrow 1 million, next you borrow 10 million, 100 million. Of course, as much as debt is very, very good, it gives you what we call gearing. It gives you what we call leverage, right? You're able to lever on it to create more wealth, right? But at some level, it will become very, very risky. You could very easily, in this case here, lose all your assets, all your collateral. So at the end of the day, then we must balance between this debt and equity. What is that balance we should strike to ensure that we are able to maximize on the owner's what here? Wealth. All right, give us another title there. All right. So analysis of breakpoints. And a weighted marginal cost of capital. Analysis of breakpoints like this analysis of breakpoints and the weighted marginal cost of capital and the weighted marginal cost of capital, what we shall be calling WMCC, weighted marginal cost of capital. Weighted marginal cost of capital, shall write slowly. So we are mentioning there that WMCC measures the cost of the next shilling. WMCC measures the cost of the next shilling of capital raised. It measures the cost of the next shilling of capital raised. Full stop there. Breakpoints occur when the cost of one source. Breakpoints occur when the cost of one source of finance changes. Yeah, breakpoints occur when the cost of one source of finance changes. So we have there the formula for getting breakpoint. So this is the gist of our today's class. How do we get this breakpoint? So anytime they want us to get this breakpoint, my good students, breakpoint, we shall always be taking the maximum amount, available, maximum amount available over the weight, over the source of capital. So anytime they want us to get the breakpoint, any breakpoint, we shall be taking the maximum amount available divided by the weight of the source of what here? Source of capital. Ladies and gentlemen, we have three types of, or rather three sources of capital. So we have what we call equity. Can somebody in this case here give me components of equity? Equity refers to the owner's capital, the ordinary shareholders' resources. The first one is what here? Retained earnings. So we have here retained earnings here, retained earnings. The ones that we shall really be interested in this case, ladies and gentlemen, that we can use as our sources of capital for equity, we shall be able to get money from what the owners have allowed us to retain in the accounts. So whenever we have good projects, we shall be, in this case here, raiding this source and using that particular resource in our projects. Then number two, we have what we call ordinary shares here, or ordinary share capital. Ordinary share capital, yes. Now, let me ask you a question. Between these two sources of equity, which one is cheaper? Which one is cheaper to raise capital from? You see, retained earnings, already we have this in our accounts. Retained earnings, the money is already in existence, isn't it? You know, anytime you want to raise money through ordinary share capital, what does it mean? First of all, you must advertise. Na pia lazima upembeleze our shareholders sana. So you must, in this case here, get, for example, an investment banker. First of all, will be able to help you craft a very compelling prospectus. It's not easy. Yeah, because at times you may try to issue new shares and there is nobody who is interested, especially if you are making losses. All right. So this becomes very costly because of also the cost of underwriting, insurance, yeah, etc. So this is normally cheaper. So assuming that you calculate in this case here the cost of this, and you get like 10%. All right. And the cost of this, of course, they cannot really be very far away. So maybe this could be like 13%. So you see, for example, if the retained earnings you have in the bank accounts are 20 million, so it means that you will be able to spend these retained earnings up to 20 million. At what cost of capital? 10%. Once in this case here you exploit your 20 million, then automatically you will now be able to go to an expensive source. So you're breaking to an expensive source. That is the concept of breakpoint. And to be able to get this breakpoint, we shall always be taking maximum amount available divided by the weight over the source of capital. So we look at our question from the past paper. We look at our question from the past paper. And as they open this question from this past paper, ladies and gentlemen, I would want to ask the online students a simple question. May 2017 question number 1B. The online student, I'm aware that you guys happens to be having what we call advanced financial reporting class ongoing. And I can see 44 students online. Does it mean that you guys are not doing AFR? It's good for you to always follow your timetable, because even if you miss this class, you'll be able to get it in your videos, right? In the learning management system. Don't run away from AFR, because AFR is more serious than AFM. All right. May 2017, question number 1, boy. We are going to do only one question, which may take us like 30 minutes. And the moment we finish that question, so long as you'll be very attentive, we go home. We go home. The class comes to an end. May 2017. But again, unfortunately, the question will not take us 30 minutes. May 2017, question number 1, boy. Once you get the question, are you able to say, yes, it is, it is Kenzel, isn't it? Kenzel. The online ninjas, I hope they have gotten. The online ninjas, I hope they have gotten. I will share the handout, yes. Great. Not doing AFR or AFR morning, great. Great, thank you so much. Yeah, great. So what is Kenzel telling us this evening? Kenzel Limited has the following capital structure, which it considers optimal under both the present and the forecasted conditions. So they have given us this source of capital, long-term debt. And then number 2, we have equity, what year? Capital. So those percentages they're giving us there, what do you think do they represent to us? Remember, you are a finance manager. Now you reason like a very strong finance manager of a very big company like EABL. Not a finance manager of a company from Kirinyaga Road. So those percentages in this case here stand for the weights. So basically, they're giving us weight of debt and the weight of what here? Equity. So right there, weight of debt. So this weight of debt is WD, which in this case here, they have given us a figure of 0.what here? 0.45. Then we have weight of equity. Weight of equity, they have given us this is WE, Weight of equity will be WE, which is 0.what here, somebody? 0.55, isn't it? You see 55% is the same as 0.55. Yeah, so we continue, ladies and gentlemen. We are told the management of Kenzel Limited forecasts the after-tax earnings for the forthcoming year at 2.5 million. The company has been paying 60% of its earnings as dividends, and this payment ratio is expected to continue into the foreseeable future. What is it that these guys are trying to communicate to us there? Part of the earnings will be paid out, isn't it? But you see, as a source of finance, we are always concerned with what will be retained. So then can somebody in this case here tell me what will be the retained earnings from that statement there? Free marks, low-hanging fruits, retained earnings. So retained earnings, ladies and gentlemen, in this particular case, you see they have told me that they normally pay what here? 60%. And if they are paying 60%, in this case here, ladies and gentlemen, they're retaining 40%. They're retaining 40%. So the retained earnings will be 40% of their forecasted profit, which is 2.5 million. 2.5 million. 2.5 million. So the online students, if I'm not able to look you straight to the eyes, don't think that I'm a shy man. There are some ninjas here who have told me to put my camera not very straight. So at times I forget my camera, but I'll try as much as possible to look in your eyes. Are you seeing that problem that I'm not looking at you? Are you able to notice? Are you able to notice? No, okay, great. That is good. That is good. That is good. Understood, yeah. So because the camera is somewhere there and I have to look at them as well, but we shall overcome. But I hope you are able to follow. That is the most important thing. And how much are we getting here, by the way, as retained earnings? 1 million. Thank you so much. This financial management for you, free marks being given. Free marks being given there. All right. Now, ladies and gentlemen, we continue. We continue. So they're giving us there that the company's present loan commitments, will allow it to incur additional leverage according to the schedule presented below. The company's corporate tax is 30% in an exam that I have to underline. That is key. The question has taxation, 30%. The current market price of equity shares of the company is 22. The last dividend on equity shares was paid at 2.2 per share, and the expected growth rate is 5%. New equity shares can be sold at a flotation cost of 10% of the issue price. So Kenzel Limited has the following investment opportunities for the coming year. So by the time a student is reading that question up to there, then they start imagining, is this financial management or is it home science? It doesn't make sense, right? Required, but we shall be able to break it down slowly. So required, they want us to give them the amount in shillings at which breaks in the marginal cost of capital schedule occur. So what are they asking us to give them in this question? At which breaks? So they're asking us, ladies and gentlemen, we give them breakpoints. So they want us to give them breakpoints. So then the very first thing that I will do is to come and write down the breakpoint. And by there, I've got two sources of capital. I have two sources of capital, and I can see they have given me debt at the very top. So first of all, I will calculate for my examiner the breakpoints for debt. 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 So breakpoints for debt. So is there someone who can give me the formula? How do we get this breakpoint for debt? It's very easy. It will be the maximum amount of debt available all over weight of debt. All over weight of debt. All over weight of debt. So anytime they want us to give them the breakpoint for debt, because here we have got two sources of capital. Two sources of capital. We have the debt, and then we have equity. And anytime they want us, ladies and gentlemen, to get maximum amount of, not maximum, but breakpoint for debt, I will take the maximum amount of debt available divided by what your weight of debt. So how many classes of debt do we have in this question? How many classes of debt do we have in this question? Look at the debt, the loans table. Look at the loans table. Look at the loans table. Are you able to see the loans table? How many classes do we have? 3. There are 3. There are 3 classes. Those 3 classes, they are here. Very easy question, really. Very easy question. So these 3 classes, you can see them here under loan schedule. Under loan schedule, you can see them here. We have 0 to what here, somebody? To 500 at 9%. That is first class. 500 to 900. And then we have 900 and above. So I will write. So we have here 0 to 500,000. 0 to 500,000. Then we have 500,000 to 900,000. And then we have 900,000 to what they are calling what here? Above. So now, my good students, straight away, I'll be able to calculate the breakpoint for each of these three classes. I'll be able to calculate the breakpoint for each of these classes. It's really, really easy. Really, really easy. So we have here our breakpoints. Our breakpoints. Very easy. Easy. Very easy. So for that, ladies and gentlemen, we start with the first class. So first class, what is the upper limit of the first class? What is the maximum amount available? 500,000. So you take 500,000, you divide this by the weight of debt. The weight of debt was provided up there, if you remember. We already did that. So weight of debt, I'm told, is 0.45. 0.45. So then, ladies and gentlemen, are you able to give me this breakpoint? Looks a funny figure. 500,000 divided by 0.45. 11111, eh? So it is 11111, like that, isn't it? Thank you so much, Lincoln. Great. Then we go to the second breakpoint, which I'm giving you an opportunity to compute. Let me give you an opportunity to compute the second breakpoint. You must be having a very good neighbor. You must be having a very good neighbor. You must be having a very good neighbor. A neighbor who talks to you for that matter. That is a privilege that is only experienced by physical students. So of course, the online students, whenever you're around once in a while, you can pass by here and get to experience our physical classes as you say hi to the CPA Chief Ninja. The shy ninja, right? Gilbert says 2 million. So in this case here, breakpoint, the second breakpoint will be, you see, we always work with the upper limit. We always work with cumulative. Don't tell me that this class can only give us 400. No. So we always work with the upper limit. So 900,000 divided by what here, somebody? The 0.45 is constant, isn't it? Which gives me 2 million. What about in this case here, the third class? You guys must be very good at this. What is the answer for the third class? Yeah, this automatically means that the above means infinity. Yeah, so it means that the breakpoint here is infinity. That there is no maximum limit, and therefore there is no breakpoint. Just like a movie we watched some time back, if you remember, what was the name of this movie? No Surrender. No, something like that. Great. We shall overcome. So in this case here, we do not have the maximum limit. And therefore, you don't have what here, somebody? Breakpoint. Great. Let's leave this that way. We are now okay. So we go now for the breakpoints for what here, somebody? Equity. Breakpoints for equity. No retreat, no surrender. Yeah. No retreat, no surrender. No limit, no breakpoint. I'm surprised that I can get a CPA student who knows these videos. You know, I always find CPA people to be boring, right? Yeah, if you ask them whether they have ever gone to a movie theater, they'll tell you no. Yeah, if you ask them whether they know how to dance, no. We shall overcome. We shall overcome. So breakpoints in this case here for what here? For equity, and I will give you 3 minutes to try computing the breakpoints for equity. Just try, even if you don't get it, so what? You should not be afraid. There is nobody who is paying your fees. You're paying your fees yourself, isn't it? Or you even blog. I need to read your blogs, Goretti. I will be very happy to read. Yeah. CPA classes for beginners, Jackson? Is it possible you call this number, Jackson? Or are you asking beginners like yourselves who have joined today and you would want a recap of the topics that have been done? If that is the case, then I can answer that. Breakpoints for equity. So we have Gilbert, who has already been able to give me many 18s, 18, 18, 18, 18. Gotten something? That 18. 18, 18, 18, 18, 18, 18. Ama we shall overcome. So thank you so much. The students who are getting 18, I'm really, really impressed because I've not taught you this yet. I'm really, really impressed. So remember, those students have been able to know that equity, we have got two classes. We have what we call retained earnings. You can write in full, eh? And then we have what we call ordinary share capital, isn't it? So remember, retained earnings, these people told us it will be 40% of our profit after tax. So whenever we get profit after tax, we give away as dividends 60%. And then we retain what percentage? 40%. 40%. Yeah, so maybe I could just read this part, this paragraph. Let me just read this paragraph. There's a paragraph that is alluding to that, which told us very clearly. Yeah. No, I haven't yet gotten it. It's here. Yeah. The management of Kenzel Limited forecasts the after-tax earnings, what we call PAT, profit after tax, for the next year to be 2.5 million. The company has the tradition of paying out 60% of its earnings as dividends, and this payment ratio is expected to continue into the foreseeable future. All right. So then when they pay 60%, we shall be able to retain what percentage here? 40%. We shall overcome 40%. So we shall retain 40%. So 40% of the 2.5 million, which gives us how much, ladies and gentlemen? 1 million. And then when I continue now, so at least this one, I know that this source can give me a maximum of how much? 1 million. How about this source? This examiner wasn't really very tough. This examiner wasn't very tough. If I was the one setting this question, I would have come and told you that for ordinary share capital, we can raise like another 2 million out of this ordinary capital at this price. Then I give you another class, raise like 30 million for 18, like that. But this examiner never gave us classes of ordinary share capital. Actually, he has not given us any maximum. He has never not given us any class. What he has told us, if you read about this ordinary share capital, second paragraph, after the loans table, we are told the company's corporate tax rate is 30%. And the current market price of the equity shares of the company is shillings what here, somebody? 22. The last dividend on equity shares was paid at 2.2 per share, and the expected growth rate is 5%. New equity shares can be sold at a flotation cost of, I like that. New equity shares can be sold at a flotation cost of 10% of the issue price, but they haven't given us maximum amount that we can raise from these new shares. So there is no limit that is given, and therefore there is no break point. So for share capital, we shall not calculate any break point. We are only going to calculate break point just for this. And who can give me the formula for this break point? So this break point, I will take the maximum amount of equity, available. We divide by weight of what here? Weight of equity. We divide by weight of equity. So in this case, we shall only have one BP, one break point. The maximum amount from these retained earnings, you guys have given me a figure of 1 million. What was the weight of equity from the above analysis you had done? 0.55. Thank you so much, Alfred, for bringing that thing of recording. We shall not forget. We forgot yesterday, and I don't know whether I'll be able to get time to record what we never recorded. which then will end up giving me 18 point what here? 18, 18, 18. Evo. 18, 18, 182. 18, 18, 182. How about the ordinary share capital? No break point. No break point. Like that. No break point. So by doing that, how many marks have you gotten? Was that examiner generous or not generous? How many marks for calculating the breakpoints? Ah, 3, yeah? Are those good number of marks? There are very few. Those can make you see places you've never seen before. Yeah, 3 marks are too many. They're too many. Yeah. So then we go to number 2. Number 2 of this question. Number 2 of this question. So number 2 of this question, ladies and gentlemen, they want us to do very few things there. Very few things. So I'll read first of all number 1. Number 1, they wanted us to calculate the amount in shillings at which breaks in the marginal cost of capital schedule occur. And then number 2, the weighted marginal cost of capital in each of the intervals between the breaks. So they want us, ladies and gentlemen, to give them the weight, that's number 2, weighted marginal cost of who? Capital. How do I get this? I will be able to take the weight of equity, cost of equity, yeah, plus weight of debt, cost of debt. But now remember, cost of debt, this has to be adjusted for tax. There are only 2 sources of finance here. It is equity and debt. Now that you guys graduated very well from financial management, can you kindly tell me, why do we normally adjust this KD for tax and not KE? Your finance managers, one day you'll be asked that question. Why do you adjust KD for taxation and why not KE? Yeah, because KE, cost of equity, it is the dividends being paid to shareholders. And dividends are never allowed for taxation. You can never charge in the income statement dividends that you have paid to reduce your taxable profit. Never. Those are never allowed. How about KD? KD is interest. Interest is tax allowable. Interest is tax allowable. So is that okay? That a KE, we can never. KE, we can never. So you see, we don't have a problem with the WE, we already have. And we also have WOT here, the weights we have. But we don't have the cost of a capital component. So first, calculate the cost of capital components. So first, calculate the cost of capital components. Calculate the cost of capital components. Yeah. So we first calculate the cost of capital components, and we shall start with the cost of whichever. Let's start with cost of equity. So cost of equity is what we call KE. KE. Now I would want to pause a little bit, ladies and gentlemen, and ask you a simple question. As I've told you, I know that all of you are not here by any mistake. All of you passed financial management. And one of those topics that you did, which was really, really easy, is what we called valuation of securities. And one of the securities you guys valued, we used to call it PO. Yeah, the value of an ordinary share. Value of an ordinary share, the price of an ordinary share. Like if today you want to know what is the intrinsic value of Safaricom's share. Intrinsic is different from market. Yeah, intrinsic is what you get by discounting the cash flows. So is there anybody who is able to remember the formula? Don't write this. PO equals who? Just remember, PO is O stands for current today. Guess. Yes, online guys right there. Don't pretend that now you can't type formulas. If you don't know, you don't know. Yakeri is saying mwalimu I did not upload class ya jana. Hiyo mnaharasa jamaa anaitwa Franco. Misa kazi yangu imekuwa mingi. I don't even get to read many things mnantag. Kwa jamaa anaitwa Franco hapo wa LMS. Nampigia. Great types of value of getting very good suggestions from online students, physical students haven't gotten any. Ama we shall overcome. Yeah, yeah. Somebody has mentioned something correctly here. Yes. Mm. PO, this concept of provincial officer, so it means I'm not the one who taught most of you financial management, because if I taught you, you must be remembering this. Yeah, remember PO, this is what basically we call the Gashagua's model. Gashagua left us with a model, even after leaving government. He left us with a model. Remember, this gentleman used to be what here at DO, isn't it? Some time back. And for sure he grew. Yeah. So DO, like that. Why do we use this as Gashagua's model? Remember, DO stands for dividends. This is the gentleman who kept on telling us what here? My shares, isn't it? Yeah, my shares. Serikali ni ya share? Ni ya shares. These shares that grow next time kama mtakuja ndani, isn't it? Yeah, growth rate like that. And then you come and say here divided by Kenya. Without Gachagua, there is no government, isn't it? Kenya without government. I know you don't like that, but just write this one here. Kenya without government. And we are recording this, but don't kill me. I'm just using this for purpose of demonstrate. I don't support any political party. I don't have that time. I don't have that time. I'm so sure if I taught you, this is a formula you remember very well. And it used to come out clearly when Gachagua was in government. Right now, it may not be very, very good. Yeah, because after he left, now we have the opposition is in government. I mean, it's a funny kind of government. So Kenya without what here? Kenya without government. Now, ladies and gentlemen, please listen. Listen and listen to me very well. Today, we are not looking at valuation of our share. Today, we are looking at what we call cost of capital, cost of equity. So I want you great students of mathematics to come and make KE the subject of the formula. Make KE the subject of the formula, the subject of the formula. Somebody is telling me, Mwalimu, you can be a governor of RCM, not governor outside there. No, it is terrible. Mwingine ananibox hapa ati mwalimu unapenda Gachagua. We. Sasa kwa nini? Yangu ni kufunza tu. The only thing naweza penda Gachagua ni anasema akiingia na wacha mambo ya affordable housing. Hiyo kitu ya affordable housing sio clear. Hiyo peke yake tu. Tunataka tukicontribute, it's a very good way of saving, but at least I should be guaranteed of getting a house. Yeah, even this government, if it can change that, because like some of us were really paying lots of that money, knowing very well that we can't get any house. There's no equity there. That is the only biggest problem we have. Because if it's corruption, there is nobody among us, all the guys we have, is clean. When Gachagua akiingia, international disaster. Kama mtupatie Gen Z moja. Gen Z wanazaiba kipata chance. Hamwezi iba. Mtaingia na njaa yote kwa serikali. We shall overcome. We shall overcome. So we are making KE the subject. Please listen. Listen here. Look at what I will do. I will come here and cross multiply. So it will be PO into KE minus G equals DO into 1 plus G, like that. You see, in mathematics, I don't have to open the brackets. I can treat this as one number, and then I divide both sides by what here, somebody? PO. I divide both sides by PO like that. So that this and this cancels out. Meaning that my KE will be equal to this DO into 1 plus G over PO. Yeah. And then at the end of the day, there is this G which has to cross over, isn't it? Yeah. So plus what here, somebody? Plus G. Great. And I saw some guys who were able to get this. So KE equals DO into 1 plus growth rate all over PO. This is really independent. Don't add this G to the numerator alone. First of all, you compute this, and then you add the G to it, like that. So in that case, ladies and gentlemen, yeah, I like what Marceline is saying there, that everyone is corrupt. It's only that we are lacking opportunities. We shall overcome. We shall overcome. So then we have here KE. I repeat again that our KE, which is cost of equity, will be equal to the dividends being paid. Yeah. And these dividends must always keep on growing, not unless your company has a problem. Yeah. All over PO plus what here, somebody? Plus G. Plus G. So this KE, I reiterate again, that this is cost of what here, somebody? Equity. We have DO. This is current because of the O today. Current dividend per share. Current dividend per share. Then we have PO, which is current MPS, current MPS. Then we have G, which is the dividends growth rate. Dividends growth rate, like that. Dividends growth rate. Dividends growth rate. Dividends growth rate. So I would want you guys to scratch your hairs and try as much as possible to compute for me the KER. I'll call it KER. Can somebody tell me why am I calling it KER? The first one you compute is called KER. Why? Because it's the cost of equity but retained earnings here. So I want somebody in this case here to compute this KER for me. Just try your best. Try your best. Within 2-3 minutes, try your best. KER. KER. So I'm so sure there is a student called Purity. She's just waiting for 6:50 to tell us Mwalimu break. Yeah, that's an area I know that Purity excels. Yeah. So cost of equity, retained earnings. Cost of equity, retained earnings. But it should be around 6:55, Purity. Cost of equity, retained earnings. Once we finish this, then now we can take a break. Imagine you just read through and identify a place where they are talking about shares. What are shares? Yeah, then they'll be able to tell you, okay, maybe there is another Purity we shall overcome. You'll be able to see the current price of the share. You'll be able to see the current dividends being paid, and the examiner is gracious enough to always give the growth rate. Just look for a paragraph talking about shares. Or you're finished already, or you're meditating. It's also important you meditate in this subject. Yeah, this subject needs a lot of meditation. Yeah, cost of equity, retained earnings. I have one Gilbert Onsando getting 15.5, and it is correct. Gilbert, do you have a Safaricom line? I send you some M-Pesa. I don't have my phone here when I come from break. Yeah, you'll give me your number. I send you something. Yeah, I'll be able to bring my phone after break. Gilbert, I like the speed. I like the speed. Barvin, great. Great. You got 15.5? 0.155. But see, don't be very surprised because you're correct. You see 0.155 percentage wise times 100, it's 15.5. So you'll also get 1,000, Bob, right? Yeah, great. 15.5%, isn't it? 15.5%. Is there somebody who has not gotten, who wants us to do it together, Gilbert? Yeah, anybody who wants us to do it, we do it together. Yes, there are many, especially online, there are many, which is really good, but I want to believe that you tried a little bit, because when you try a little bit, then you'll be able to love the subject. You'll be able to love the subject. Otherwise, if your work is to copy what Mwalimu is writing or rather giving you, then that means that we are here studying about Vasco da Gama. History. So there is a paragraph here after the loans saying the company's corporate tax is 30%. The current market price of equity shares of the company is 20 what? 22. So what is that to us? That is P0. The current market price per share. is 22. Is that okay? Yeah. And then we continue, ladies and gentlemen. We are told the last dividend on equity shares. Last means DO, historical. So the last dividend paid, which is DO, they have told us is how much there, somebody? 2.2, isn't it? So DO is 2.2, like that. Yeah. And the growth rate expected is what percentage there? It's 5%. Thank you so much. Then we are told the new equity shares can be sold at a flotation cost of 10% of the issue what year? The issue price. Please listen that flotation cost is never applicable when calculating retained earnings. Because there's nothing you're floating. You're only going to get consent from the owners of the company, maybe in an AGM, to read their bank accounts to finance a project. So flotation costs are irrelevant while calculating cost of retained earnings. Irrelevant. That is why when I write later on, when I'll be writing here cost of equity shares, you'll see I'll say PO minus F. When it's about what your shares. But retained earnings already this money in the bank account. So then armed with this information and this formula for sure, I will be able to get my cost of equity. I'll be able to get my cost of equity retained earnings, which will be my DO. DO is 2.2 into 1 plus growth rate 0.05 all over PO. 22, isn't it? No flotation cost at all. Whatever answer I will get here, I will come and add that answer to 0.0 what here, somebody? Because you see 5% is the same as 0.05, like that. So here you have to move slowly. You say 2.2 times open brackets. We have here 1 plus 0.05 close, divided by 22, isn't it? Yeah. Then whatever answer I get, I add 0.05 to it. So is there somebody who is able to get 0.155, which is the same as 15 point what here? 15.5%. So after our break, we shall be calculating cost of equity, but now for ordinary shares like that. So please, if you're not going for break, ensure that you calculate it. Perhaps you'll also be among the beneficiaries of the 1,000 bob, isn't it? So we shall come back at exactly 7. Oh, Purity, this is your very first time. Okay, no problem. But also breaks are important. They're important. Don't deny. They're important. Thank you so much. I'll be coming back. I'll need to stop the recording. Pause. Thank you. So everything in this case here will remain the same. For ordinary share capital, just like it was in dividends, it will be DO into 1 plus G, yeah? All over what here, somebody P? O, but this time round, we have what we call flotation what? Cost, yes. This time round, we have flotation cost. And then plus what at the end of the day? G. So in this question, what is the flotation cost? They have told us as it's 10% of the price, isn't it? It is 10% of the price. Flotation cost is 10% of the price. So then this means that it will be 10% of what figure somebody, what is our current price? 22, which gives us 2 point what here? Which gives us 2.2. So and once I get that, ladies and gentlemen, we shall be able to get cost of equity, ordinary share capital, which will be equal to DO. What is our current dividend? Current dividend is 2.2, right? Into 1 plus growth rate, which is what here, somebody? That remains at 0.05, isn't it? All over PO. PO is the current price, 22. All over 2.2, or rather minus 2.2. Then whatever answer I will get, I will come and add the growth rate. So treat this as 1. So if I'm the one who is doing this, I will say 2.2 times, open brackets, 1 plus 0.05, you close brackets. Then you say divided by, open brackets for the denominator. Open brackets for the denominator. So we have 22 minus 2.2, you close, equals, because this term is very independent. And then whatever we shall get, we shall come and add 0.05. Whatever we get, we shall come and add 0.05. That is how these great ninjas got, in this case here, 16.what here? 679. And of course, I know there must be somebody who is expecting me to give them 1,000 more. Nothing. But the next one will give you money. The next one will give you money. The next one, you will get money. That one I promise. That one I promise. Received, yes. Thank you, Coach. Great. Thank you so much. Now, ladies and gentlemen, have we finished doing the question? No. They wanted us to give them WOTR MCC. So they want us to give them WMCC. And normally this is what defeats like all students. But of course, that will not be your portion. Yeah. So then how do we do this WMCC? First of all, we have to do what we call the WMCC schedule. WMCC schedule here, where we start with the breakpoints in ascending order. Breakpoints in ascending order. From the very smallest to the very highest. Now, please listen. Remember, we had our breakpoint somewhere here. We had our breakpoint somewhere here, if you remember very well. We had the breakpoints of debt. Debt. So debt, what was the first breakpoint? Was it 1111 something? For debt, is there somebody who is able to remind us what the breakpoint was? Yeah. So we have here, the first one was 11111. And then the second breakpoint, 2 million. Thank you so much. And then the third breakpoint, infinity, yes. And then we went to equity. So under equity, we had one breakpoint alone. And this breakpoint was what here, somebody? 1818 182, isn't it? 1818 182. And then, of course, we have a second breakpoint, which was in fee. So could you kindly organize all these breakpoints in ascending order? Yeah, from the very smallest to the very largest. So the very smallest is 1111. What is the second smallest? 18. So we have here 18, 18, 180. And then followed by what here, somebody? 2 million. And then lastly, we have infinity. Remember, infinity is what we call above. Infinity is what we call above. So you organize all your breakpoints in ascending order. In ascending order. Now, ladies and gentlemen, once you finish doing that, you will come and give us what we call the ranges. The ranges, very easy. The ranges, very easy. The ranges, very easy. So these ranges, these are normally the maximum amounts. So normally you start with 0, then you say up to 1111, 111, like that. The second class, you say over 1111, up to this figure, up to 18, 182. How about the third class? Can you write the third class for me? Write the third class for me, please. Write the third class for me. Try writing the third class, and then we get to see how far do we go with this. Sorry. Thank you so much, Margaret Wanjiro. Margaret has used very good terminology here. So of course, this covers up to, and then now we have over. So we have here over 18, 180. Up to what amount? Up to 2 million. Up to 2 million. How about the last class? Over 2 million. Over 2 million. Up to what here? Somebody in fee? Up to infinity. Once you write up to there, then you are a genius. You're a genius. Now, for each of these classes, we are going to post our costs. Remember, we said weighted marginal cost of capital is an incremental cost of borrowing. Yeah, the cost of the extra coin as you raise your financing. Yeah, the extra. Now, please listen. Thank you so much. Listen. We start with this cost of equity. Now, cost of equity, I'm aware that we have two costs of equity. I'm so sure you must have forgotten them. You must have forgotten the cost of equity. The first one was the cost of equity retained earnings, which was 15%. 15.5%. How about the second one? 16.65, 65%, like that. So I want us to post the cost of equity. So I post the cost of equity for your eyes. And then we shall be able to post the cost of debt now for 1,000 shillings. So please be very attentive on how I post the cost of equity. Now listen, you can see we have got how many costs here? 2. Yeah, breakpoints are how many? Actually 1. The other one is just infinite. So the first cost of equity will run up to the first breakpoint. It will run up to breakpoint 1. So it will keep on running up to breakpoint 1. Beyond that breakpoint 1, it increases to this higher amount. So this 15.5% goes up to 18,182. Fungua macho vizuri uone hapa. So cost of equity will go up to what, here somebody? This 18,182. So I will post it twice here. So I will post this one here, 15.5%, and here. Because 15.5% is running up to 18,182. Once in this case here, we exceed this 18,182, we go to a higher and increased rate, which is 16 point what here now? 16.65, which will run up to where? Up to infinity, yes. So then how many times do I write it here? Twice, because you see now beyond this, it will be 16.65, 16.65. So then can somebody, of course I will repeat this, but go here and post for me KD for 1,000 bob. Of course, I don't want all of you to get 1,000 bob. I don't have that enough money. So for KD, come and post KD here. We see how you'll post this KD. Just try your best, and I can write for you here. I can write for you here. I can write for you here. Now, I can write for you here. Listen and listen to me very well. I will be troubling you for nothing. You see, like now here, already you have gotten the cost of what here? Equity. But you don't have cost of what here? Cost of debt. So like now here, immediately what I need to do is to come and compute my KD1. I will have KD2, and then I will have KD what here? KD3. There'll be KD, 3 of them. We must compute them. Ladies and gentlemen, if you remember very well, from those levels of financial management, you are told for bank loans, these are bank loans. These are bank loan. Yeah. In this case here, no redemption period. No redemption period. There's no redemption period here. So for bank loan, you are told that your cost of debt, you will be able to take the KD given, you less what here, somebody? Tax. You less tax. So anytime you hear about cost of debt and there is no redemption period, this is what we shall be doing to get cost of debt. Cost of debt. So you'll take the KD given, right? And then you subtract what here, somebody? Tax. Now, please listen. Remember, we had the 3 tables, or rather 3 classes for debt. If you remember very well, for debt, we had 3 classes. We had the first class running from where to where? William alone, 0 to 500. The first class was running from 0 to 500,000, 0 to 500,000. And in this case here, we have our KD here. Our KD here, which is what here, somebody? Is it 7%? 9%? The first one is 9%. And then we had 500,000 to who, somebody? To 900,000. So this one here gave us what percentage? 11%. And then we had 900,000 and above, which in this case here gave us what here, somebody? 13%. So the only thing that you need to do for these interest rates is to adjust them for taxes. Adjust them for taxes. Remember, the rate of tax has been given. Is there somebody who is able to see the rate of tax? So it will be KD into 1 minus 30%. Yeah. So like now this will be 9% times 0.7. This will be 11% times 0.7. This will be 13% times 0.7, like that. There is no redemption period. There is no redemption period that has been provided. So we shall treat these as normal bank loans. And if they're a normal bank loan, we simply adjust the rate of interest given the tax rate with a given tax rate. Because remember, interest is normally tax allowable. Interest is normally tax allowable. So remember, this is given on your paper, right? 0 to 500,000 debt, 9%. 500,000 to 900,000, 11%. The only thing that we need to do is to come and basically do what here? Take away tax. The first one I'm being given 6.3%. Is that okay? First one is 6.3%. How about the second one? 7.7%. 7.7%. How about the third one? 9.1%. So we have here 9.1% like that. So please come back here. Come back here. So now you have what we call the effective interest rates. So this one here is 6.3. You bring this to the breakpoints. Yeah, this is 7.7%. And this is what here, somebody 9.1%. So you remove them from that table and come and post them. And remember, these are effective. They are after what here, tax. How do we interpret this, my good students? This 6.3% will be applicable up to the first breakpoint. So 6.3% will run up to 1,1,1,1,1. And then 7.7% will run up to 2 million. And then 9.1% will run up to infinity. Can you kindly try your luck and see whether you can post them there under KD? Just try. Even if you don't get it right, no problem. So long as you're able to take these figures from here, post them there, you are a genius. If you take them from here, know how to post them there effectively, then automatically you are a genius. Let's try. Let's try. So I can see in the schedule, there is somebody who should get my 1,000 bob here. There is somebody who should be able to get this 1,000 bob here. And that is Lincoln, Lincoln. I think Lincoln has gotten this. Lincoln has gotten this. Just getting the information from there, and then you post on this schedule. So long as you understand that the 6.3% is applicable up to 1,1,1,1,1. The 7.7% is applicable up to 2 million. The 9.1% is applicable up to infinity. And then you shall always smile in an AFM class, even when you're at home. Always smile. Always smile. Always smile. You must like the paper. You must like the paper. You must like the paper. Can I assist you? Yes, sir. The first one is 6.3. The second one, 7.7. Amtaki brother apate kitu. Mbona mnaongea na nguvu sasa? Amtaki brother apate kitu jamani. Niwapatie wewe. We shall overcome, because you see the 6.3% is applicable up to 111, isn't it? So this 6.3 is applicable up to. So this is 6.3%. From there now we go to 7.7, which is applicable up to 2 million. So up to 2, I can see then I will be able to have it here and here, isn't it? Yeah. And then now, of course, after 2 million, we go to the most expensive, which will be 9. What here, somebody? 9.1%, isn't it? 9.1%, like that. So, ladies and gentlemen, after you've done that, now you'll be able to give us the last column here, which is the WMCC. So come and give us the last column, which is a WMCC. Let me ask you a question. Plus weight of debt, cost of debt, after tax, like that. So do we have the weights? Is there somebody who is able to remember the weights? Weight of equity was 0.45 and the weight of debt was 0.55. So then go ahead and post for me the WMCCs. Go ahead and post for me the WMCCs. Go ahead and post for me the WMCCs. I've already given you the way to go. I've given you the formula. So perhaps I could do the first one. Let me do the first one. So you see the weight here is 0.45 for the first class, right? 0.45 equity times 15.5% plus 0.55 times what here, somebody? 6.3%. So am I going to adjust this for tax? That will be double taxation. Already our figures here are effective. We have effectively removed taxation. 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 So remember, this evening class is way ahead of the online classes. We are way ahead. Unfortunately, these students don't get to attend our revision classes, because they can't, like, the Friday evening, they can't attend because that is the time they are finishing from here. But fortunately, they get to watch videos, right? So the student is telling me that Mwalimu, this is 10.44%. Is that okay? I'm alone, but I will overcome. I'm alone, but I will overcome. 10.44%. The second one is 11.21. I'm being told that the second one here is 11.21. 11.21%. Is that okay? Because you see the second one, this class here, the weight of equity is 0.45 times 15.5 plus weight of debt, which is 0.55 times cost of debt, 7.7. Can somebody confirm that that 11.21% is correct? The online ninjas, do you have a figure for the second class, second category? The online ninjas, do we have a figure for the second category? Yes or no? Yes or no? Same. I'm being told that WE is 0.55. Woi. Haikuwa 0.45? Hebu angalia vizuri, tumeinterchange. Hebu angalia kwa question. Hebu angalia kwa question. Hebu angalia kwa question. Hebu angalia kwa question. Tumefanya vizuri mambaya? Naambua ni mbaya. Naambua ni mbaya because naambua kwamba weight of equity is point. Lakini unajua kupotea njia ndio kujua njia, isn't it? So weight of equity is 0.55. And then weight of debt is 0.45. Now that is correct, right? Please go ahead and make changes. Don't get angry at me. Yeah. So it's supposed to be 0.55 here, right? Yeah. And then 0.45 there. 0.55 here and 0.45 there. Like that. Thank you for giving us the corrections. Will the answers be the same? I doubt. The answers can't be the same. The answers can't be the same. Are they the same? Or you are giving me the correct answers? Or you don't want to repeat? We shall overcome. All is well. All is well. All is well. The first one I'm told is supposed to be 11.36 now, right? The first one is supposed to be 11.36. 11.36. How about the second one? So the third one here will be 0.55 times 16.65 plus 0.45 times 7.7%. Then we have here 0.55 times 16.65% plus 0.45 times 9.1%. So are you able to give me the answers now? Pretty fast. 11.99. Then we have, ladies and gentlemen, the next one. Kindly check the second last. The second last should be the second last is check Mwalimu. I think it should be 9.1. Huh? 9.1. But now remember, 9.1 was only applicable for infinity, if I'm not wrong. Because this 7.7 was going up to 2,000, 2 million actually. Yeah, so once it starts here, it has to go to 2 million. From there, we have this one for infinity. For infinity. So we are right. So the next one is supposed to be 13 point, no. The second one is supposed to be 12.63. 62, eh? So 12.62, yeah. And then the third one, this is supposed to be 98. 99, and then 12.62. And then lastly, 13.25. Thank you so much. So that is the answer. That is the answer. So then I would want to make a request. I would want to make a request, my good students. This camera can't see those figures. All right. So I would want to make a request here that I leave you behind doing this question. You do this question from the very beginning up to where we have reached. You'll thank me later. You do the same question. How are we able to get the KEs? How are we able to get the after tax cost of debt? And then how do we draw this WMCC? So when I come the next class, I'm able to do one question complete, and then I go to the Modigliani and the Miller theories. We finish that chapter. We go to chapter number 4. Yeah, I told you once I've done chapter 1, chapter 2, all these other chapters will really flow very, very fast. So it has been a pleasure hosting you. So see you again. See you again. Thank you. Lincoln, Mwalimu, don't forget the 1,000. So you'll have to call me Lincoln, and then I'll organize with some person who will send this cash to you. Yeah, that's my personal number. 0721-620-183. You can even write this Lincoln. I'll be able to know what to do. Na pesa yangu mwe mnatoa tithe, hapa naenda kuchapa kitu na pesa yangu, nitakuwa maskini. Asante sana. Bye.